Welcome everybody. We are Compass, and this is our Webisode series where we navigate through the latest industry news, cut out the noise, and get to the good stuff. Today we're going to tackle 6 common 401k errors. What are they? And some tips on how to avoid them. I'm joined by 2 very special guests from our wonderful team here at Compass. So please welcome our in-house 401k experts, Denise Clare and Anne-Marie Jeremy. Welcome to you both.
Thank you.
Would you please take a moment and introduce yourselves to our audience out here?
Hi, my name is Anne-Marie Jeremy, and I am a relationship manager here at Compass, and I work very closely with Denise. She is my team's fearless leader, so we're excited to talk to you about things that we work on a lot, common 401k errors.
Welcome everyone. As you've already heard, I'm Denise Clare, and I am the team lead for the Compass Relationship Managers. I've been working as a TPA for close to 30 years, so I am very expert at 401k errors.
Thank you both. Great, we're looking forward to this. So now let's get into what you need to know about common 401k errors. As with all of our episodes, we're going to dig into the main topics and then open it up to questions at the end. So please feel free to submit any questions in the chat box at the bottom of your screen as we go through this, but we'll save all the questions to the end. So now let's get to it. So most times you'll see top 10 lists for questions. We're only going to cover 6 because usually our clients only have trouble with 6 things or much better than others out there. But the first one is error on planned contributions going to the incorrect source. And so why don't we start with Anne-Marie?
Sure. So when we talk about this, we're referring to when you're making your employee and employer contributions deposits at your record keeper. So oftentimes when you log on and you're getting ready to do these deposits, you see a lot of different sources, and by sources I mean pre-tax deferrals, Roth, it might be safe harbor, might be a match. So that's what we're referring to when we're talking about sources. So problems can arise here when money is inadvertently deposited into the wrong source. So this can cause lots of issues if, for example, your plan might have a provision for loans or in-service distributions where money is only allowed from certain sources. So one of your participants might be interested in taking a loan or an in-service distribution, log on to the website, and they might have a skewed picture of what's available to them because money has been deposited in the wrong source. So furthermore to that, if a distribution is then taken from the wrong sources, there's a pretty lengthy correction process involved. So we want to make sure that those are going in the right sources. Another one is, and this happens pretty often actually, is when pre-tax money is put in the Roth source or Roth money is put in the pre-tax source. So same as you know, there's different tax requirements for those sources. So it's really important that we get them in the right buckets. So if you ever have questions, please make sure to just ask us, and it's better to fix it first or not make the mistake at all to begin with.
I guess I would just bring up one more point on sources, is that get your employer sources right. So as you know, safe harbor sources are 100% vested, and discretionary profit sharing or some match formulas are subject to a vesting schedule. So you could end up with problems when a person terminates and their vesting is incorrect if you have that employer money in the wrong buckets.
Thank you. Great points. The one thing I'll add there is that in our industry, we use a lot of acronyms, we use a lot of abbreviations. So you'll see on your different record keeper or investment provider, tons of abbreviations, ER-DEF, SH-MAT, SH-NEC. So all these different terminologies, we can help you with that. And also please check out our resources page. We've got specific short videos on safe harbor match and safe harbor non-elective and QACA type sources. So check that out. Let's shift gears now and talk about late deferrals to plans. This is a common error we see as well. Denise, you want to start us on this one?
We see this one a lot, late deposits. So regulations state that participant contributions and loan repayments must be deposited as soon as the amounts from payroll can be reasonably segregated from companies' general assets. So what reasonably segregated is defined differently for large employers and small employers. So large employers are those employers who have more than 100 participants, typically required to have an audit. Large employers need to make their payroll deposits within 3 business days. Small employers have a little bit longer. They have until the 7th business day following the payroll date to make these deposits. So when you don't make these deposits on time, they're considered delinquent and they require a correction. So the correction that needs to be made is in the form of lost earnings. Well, first thing, make the deposit. If you notice that your deposit is late, somebody's on vacation and forgot to do payroll before they left, put the money in. Then call us and we'll help you with the next part, the lost earnings calculation. This is because it's considered a prohibited transaction when the money's late. It's like the employer took a loan of the participant's money, which is prohibited. So you have to make them whole by giving them the earnings that they would have had the payroll been deposited on time. So we'll help you calculate the lost earnings, and you need to fund that to participant accounts. The next part of it is because you had a prohibited transaction, you need to report this both on your 5,500, and you have to pay an excise tax of 15% of the lost earnings, not of the whole payroll that's late, 15% of the lost earnings. And this gets reported to the IRS on Form 5330, which we can also help you do.
Thank you.
The only thing I would add to that, just like Denise said, just to reiterate, if you notice that happens, best thing to do is get those contributions deposited as soon as possible, and then let us know as soon as possible, because the sooner you get it corrected, the smaller the impact on your participants and the smaller the impact on the cost to you. So it's really important to just move quickly when you realize that happens.
Great, thank you. All right, let's move to number 3. Another issue we hear a lot about is identifying eligible employees. So Anne-Marie, why don't you start us off with this one?
Yes. So eligibility is one of the most critical, if not the most critical, things you need to know about your plan. So know what age, know what length of service is required, and just as importantly, you've got to know your entry dates. So the entry date happens when the participant actually meets the eligibility provision. So it's something that's often missed by employers because they're really concentrating on the individual eligibility provisions, but not actual participation date. So you want to make sure you know that, because it's not always immediate. You'll see in your plan documents there's some different choices there. It could be monthly, it could be quarterly. So for example, if someone became eligible on March 23rd and you have a quarterly entry date in your plan, they might not actually be able to participate until July the 1st. So it's really important that you know that. And another part of eligibility is really making sure that you're tracking it, making sure you're documenting that you're giving people the opportunity to enroll. So I have some clients who use a spreadsheet as their way of tracking, and I have others who use Outlook reminders, which I actually think are great. So you've got a new employee coming in, hired, and one of your steps can be just putting a reminder in your Outlook 6 months from now, or whatever the length of service is, about a month before they're due to become eligible. And then it will pop up and you know to give them their enrollment materials, and you don't have to worry about missing that opportunity. Because if you do miss the opportunity to give someone the chance to enroll, there are penalties and make-up funding required.
So I have a question for you, and this is something I hear a lot out there. What happens if you had an employee who has left your company, but then you rehire them back? Do they have to wait another 6 months or redo their waiting period? How does that work?
Right. So if they've met eligibility during their initial employment period, they are going to be eligible immediately upon rehire.
So they don't have to wait.
That's correct.
Okay, great.
Right. On the other hand, someone who did not make their eligibility requirement does have to satisfy the eligibility requirements over again. There are some exceptions to the elapsed time rules, but we don't have time for all of that today.
That'll be another video, but we can help. So if you have questions on that, please contact us. I will say many investment providers and record keepers now have some services through their websites to help with tracking that, but also ask us about our 316 services where we can automatically track that for you, as well as send those kits out right to those participants directly on your behalf. All right, now let's shift gears to a very, very large topic called compensation. And this is where we see a good number of errors as well. We don't have time to go into all of them, but Denise is going to start us off here, but what tips do you have and what do you see in regards to compensation?
I guess, right, I was just going to say the same thing, Chris, that it's such a complex topic, compensation. there are just multiple definitions that a plan can choose. What's important for today is to make sure that the definition of compensation in your adoption agreement is the one that's being applied properly across your payroll and across your calculations. So the most common errors we see are like failures to take deferrals on certain types of compensation, like bonuses or commissions or overtime pay. When this happens, it's referred to as a missed opportunity to defer, same as when you don't allow someone into the plan. And that may require a correction on the company's part to make the participant whole for the money that they didn't get to put into the plan. Another common payroll error we see is the failure to properly calculate company match. So as your job as plan sponsor to communicate your definition of compensation and also to make sure that match formula is being calculated correctly at your payroll provider. Compass is happy to join in those conversations and help you with it, but we just don't have the power to talk to your payroll company directly. That's just not how it works. It's your responsibility, but we're happy to help.
Yeah, I'll just reiterate, if an employee has commissions, if they have bonus payment, in 99% of situations, that compensation is included, in the plan, and they must have the opportunity to defer on that. So, all right, check out another video about compensation down the road. So we're going to keep moving along here. Another common mistake is the failure to force out terminated employees with small balances. So Amory, why don't you start us off with this one?
Yeah, so you can probably recall at some point that Compass has mentioned force out distributions to you during our annual review process. So force out distributions are distributions for terminated participants who have balances that are under $5,000. So you are permitted to force those people out of the plan, provided that you have given them a 30-day notice. So this is a housekeeping item, but it is required. So Compass will help facilitate the process for you. We help you with the forms and the notices and giving you the list of employees that you need to notify. So again, expect to hear from us about that every year. It's also important to keep in mind too, it's beneficial for you because it can keep your administrative costs down. Because you're not paying for administration on people who are no longer working for you. So, yeah.
I guess I'd just make a little note. So participants who have less than $1,000 in the plan will be immediately forced out as cash distributions. Participants with over $1,000 up to the $5,000 need to be rolled over into an IRA. So your record keepers usually have access to that and help you do that.
Great, thank you. All right, and lastly, we often see companies not maintaining a sufficient Erisa Fidelity bond. Again, we have a separate video on Fidelity bonds, but Denise, talk about this if you don't mind.
Well, a sufficient Erisa Fidelity bond is at least 10% of plan assets with a cap at $500,000. Unless you have employer securities in your plan, and then you must hold a bond. The minimum amount is $1 million on that bond. You can hold more. There's no rules that you can't hold a higher bond. The bond protects the plan from, dubious actions, from theft and, bad dealings, not the fiduciaries. It protects the plan and the plan participants. I was going to say, so the Fidelity bond amount is reported on Form 5500, and the DOL is starting to crack down on bonding requirements. A lot of small plans maybe don't have them, or maybe some of the bonds have elapsed time. So it's time to review your bond, make sure you have adequate coverage. Compass secures bonds for a lot of our clients. It's a good idea to put an auto escalation clause on your bond, so it's just a little housekeeping item. They're not terribly expensive, but it's important to have it.
Anything to add?
Just that Denise just mentioned the auto escalation. I find that clients really like that because what that is, it allows the limit of your bond to increase as the assets in the plan increase. So it can eliminate the need to renew it every year. We do check it every year to make sure that it's still sufficient, but a lot of clients like the convenience of that.
Yeah, and I'll just add, as Denise mentioned, that has to be reported on Form 5500 every single year. And there's also questions now for, did you have any late deferrals, over the course of the year? And we have the additional form to file if you did, and we have to make those corrections. So with the software that Department of Labor has, they can easily pull up searches of whose bond is insufficient, who's had late contributions repeatedly. It's okay to have one or two and then we correct it, but if year after year you have consistently late contributions, that's going to throw up a red flag. So we want to make sure we help you address that and create proper procedures, in-house. All right, a lot of great information. Thank you both. Now let's kind of shift gears and get to the Q&A section. So we've got some help from our tech team here, and let's see if there's any questions out there from the audience. Again, you can enter them in the chat bar, the chat box, at the bottom, and then we'll read them as they come up and answer them in our Q&A section here. All right, looks like we have one so far on match versus non-elective. So what's the difference of those two terms? Again, we have a separate video, but do one of you want to cover that, match versus non-elective, in terms of safe harbor?
Sure. Ready to go? Okay. So match versus non-elective. So a match is going to require that participants, that your employees actually participate in the plan. So in the form of making employee pre-tax or Roth deferrals to the plan. So then they are awarded a match. A non-elective is different because it is not required that your employees participate. So they're going to get it, if they're eligible, they're going to get that contribution regardless. So that's a difference between the match is requiring the participation and the non-elective does not.
Great, thank you. As we go through, there's a couple of questions here that are similar, so we're going to try to condense them. We'll break it into two actually. So one of them is it 7 days, just counting straight in a calendar, or is it 7 business days? And I think Denise kind of briefly touched on this, but it's worth reiterating. It's business days. So any federal or banking holidays are excluded, weekends are excluded. So it's 7 true business days is what we're counting when the deposit needs to be made for contributions.
Correct.
All right. Let's see what else is out there. We can scroll down a little bit, folks. Here's a good, similar question, but for larger plans. So this is dealing with plans that are generally over 100 employees, more specifically probably 120. They have a Schedule H kind of large plan audit. Do they allow for 3 business days from the deposit, or does it need to be immediate? What is reasonable?
What becomes reasonable? It becomes tricky. You set a pattern. So when you make your deposits, so if you consistently make your deposits on the same business day, they're kind of expecting you to make them on the same business day. So 3 days is a little bit of wiggle room, but yeah, beyond that, I wouldn't say.
Some of it depends on your auditor. I'll give you kind of a real life scenario from one of our clients who shall remain nameless, but they were using a 3 business day rule, and their auditors felt that they could do it sooner because they were, very, technical company, great software, very large bank they worked with, and the auditor showed that, hey, you're able to run payroll and electronically transmit this money within 1 business day, and so the auditors, expected that moving forward. So I wouldn't push it with 3 if you have the technology to do it faster. But again, Denise makes a great point. Get yourself on a habit, get yourself on a pattern. 1 is probably better for you if you're in the habit of doing it, and 2, it's also better for those auditors. Good question. All right, here's a great question about eligibility. So regarding an employee that's leaving, maybe getting rehired, leaving, returning, if an employee was eligible and it returns on an only very limited basis, are they still eligible because they previously qualified for the plan?
Yes. Yes, once an employee meets eligibility requirements, they are always eligible. You can't take that away from them.
Right.
Yep.
Even if they work reduced hours or seasonally, they're eligible.
Yep, good rule of thumb. Once you're in the plan, you're always in. All right, good question. All right, so looking at a few more questions here. If a plan has a discretionary match and they fund it at year end, do they have to communicate the formula to the employees at the start of the plan year? And I'll start with this one. It's kind of a tricky question, but the definition of a discretionary match is that it's discretionary, it's optional. So the employer does not have to disclose an exact percentage at the beginning of the year. They can wait to the end of the year as long as their plan document specifies it's a discretionary match and they're going to fund it at year end. Did you guys agree with that?
We do.
Absolutely.
All right. There's a couple of questions about acronyms. Again, we can, please feel free to reach out to us. Every vendor and record keeper is a little bit different. We can certainly help you with that. But we're running at the end of our time here. Again, we promise to keep these need-to-know webisodes under 30 minutes for you. So we're kind of running up at the end of our time here. So if you ever have any more questions or unsure about 401k issues, please reach out to us. As you can see here, we have a great team that can help you. And also check out our website and our resources page for more videos and great content to help you learn and prevent errors. We want to keep those error margins down and help prevent fines, penalties, and keep your plan running healthy. So again, thank you for joining us. Thank you for watching, and we look forward to speaking with you again soon.